Ever wondered if making $100 a day from day trading is possible? In this video, we'll show you what it really takes to make consistent profits. This video will cover a few parts starting from basic introduction to advanced level of understanding with tips and tricks. We'll talk about the risks involved, the strategies you need, and why it's important to set realistic goals. Whether you're just starting or want to improve your trading, this video is packed with useful tips. If you're excited to learn more, go ahead and click the subscribe button now so you don't miss any future trading guides. Let's start with point number 1. Introduction. Day trading can be exciting, but it comes with risks. If you're new to it, you'll quickly realize there are a lot of rules and restrictions you need to understand before jumping in. If you're not careful, you can find yourself restricted from trading altogether. In today's video, we're going to break down the pattern day trading rules, what they mean, and how you can stay safe while investing. This will help you avoid making costly mistakes and help you navigate the rules that come with day trading. By the end of this video, you'll understand how to trade smarter, stay compliant, and avoid triggering those dreaded restrictions. What is day trading? Let's start by explaining what day trading is. In simple terms, day trading is the act of buying and selling the same stock, ETF, or options contract within the same trading day. Unlike long-term investing, where you hold positions for months or even years, day traders capitalize on short-term price movements within a single day. For example, imagine you buy 100 shares of Apple at 9:30 a.m. when the market opens for $150 each. By 2:30 p.m., you see a price increase to $155 per share. You sell your shares and make a profit of $500. In this scenario, you've completed a day trade. You bought and sold the stock within the same trading day. But day trading isn't just about making quick profits. It requires strategy, skill, and discipline. Traders often use technical analysis to predict price movements, and they're typically looking for opportunities that will allow them to make profits quickly. As exciting as it sounds, day trading comes with its own set of rules that you need to follow. Especially if you're working with a margin account, you must be aware of the pattern day trading regulations. If you don't know these rules, you could accidentally trigger restrictions on your account, making it impossible for you to trade freely. So, understanding the rules of day trading is essential, especially for beginners. It's easy to get excited and make a lot of trades, but without the knowledge of these regulations, you could quickly find yourself unable to execute trades. In the next part of this video, we'll dive deeper into the pattern day trader rule, what it is, and how it affects your day trading strategy. What is the pattern day trader, PDT, rule? Now let's take a deep dive into the pattern day trader, PDT rule. This rule is put in place by the Financial Industry Regulatory Authority, FINRA, to protect both traders and the broader market. The PDT rule applies to individuals who trade frequently using margin accounts. But what does that really mean? First, let's define day trading. As mentioned earlier, a day trade happens when you buy and sell the same security, stock, ETF, or options contract on the same day. In other words, you don't hold the position overnight. You buy it, and you sell it all within the same trading day. If you do this more than 4 times in 5 business days, you are flagged as a pattern day trader, PDT. That's when the PDT rule kicks in. How does the PDT rule work? Once you execute 4 or more day trades in 5 business days, the PDT rule is triggered if those trades make up more than 6% of your total trades. For instance, if you place 10 trades in a week and 4 of them were day trades, that exceeds 6%, which means you've triggered the rule. Now, what happens once you're flagged as a pattern day trader? You're required to maintain a minimum account balance of $25,000 in your margin account. This is the core requirement. If you don't have at least $25,000 in your account, your trading privileges will be restricted. This means you can't execute more than 3 day trades in a 5-day period. The reasoning behind this requirement is that day trading, especially with margin, can be highly speculative and risky. By requiring a minimum balance, the rule ensures that traders have enough capital to cover the increased risks. The $25,000 requirement is essentially a safeguard for traders. What is a margin account? In a margin account, you're allowed to borrow funds from your broker to buy securities. This means you don't have to have the full amount in your account to buy more shares. It amplifies your potential gains, but also increases your potential losses. This is why brokers enforce the $25,000 minimum balance. It's a risk management measure. If you don't have that $25,000 in your margin account, your broker will limit you to 3-day trades within 5 business days. If you try to make more than that, you'll be restricted. Can you avoid the PDT rule? There is good news. If you don't want to meet the $25,000 balance requirement, you can avoid the PDT rule by using a cash account. Unlike a margin account, a cash account does not allow you to borrow funds, so you can only trade with the actual cash in your account. The PDT rule does not apply to cash accounts. However, there's a catch. In a cash account, the funds from your trades must settle before you can use them again. This usually takes 2 to 3 business days. So, while you can make unlimited day trades, you'll be limited by the settlement period. Summary of PDT rule requirements. You're flagged as a pattern day trader if you make 4 or more day trades in 5 business days, and if they account for more than 6% of your total trades. If flagged, you need at least $25,000 in your margin account to continue day trading freely. If you don't have the required funds, your trading is limited to 3-day trades per rolling 5-day period. You can avoid this rule by using a cash account, but remember the settlement period limits the frequency of your trades. 4. How to stay compliant. Staying compliant with the PDT rule is crucial if you want to continue day trading without restrictions. Here are some strategies and tools you can use to stay within the regulations. Use trading apps/tools to monitor your trades. One of the easiest ways to stay compliant with the PDT rule is to track your trades. There are several trading apps and tools available that can help you monitor your activity. These platforms can notify you when you've made too many day trades in a given period, ensuring you don't accidentally trigger the PDT rule. For example, Robinhood offers a feature that lets you track your day trading activity and gives you warnings if you're about to exceed the limit. One-time PDT flag removal on platforms like Robinhood. Some trading platforms like Robinhood offer a one-time PDT flag removal if you accidentally trigger the rule. This can be a lifesaver if you only made a couple of trades over the limit and don't want to be restricted. However, it's important to use this option cautiously, as excessive use can lead to more severe restrictions. Strategies for smaller accounts. If you're working with a smaller account, here are some strategies that can help you stay compliant. Number 1. Limit your day trades. If your account balance is under $25,000, limit yourself to 3-day trades per rolling 5-day period. This is the simplest way to avoid triggering the PDT rule. Number 2. Use a cash account. As mentioned earlier, switching to a cash account allows you to avoid the PDT rule altogether. However, this limits your trading frequency because the funds from your trades need to settle first. Be strategic about how you use your available cash to maximize your opportunities. Number 3. Trade with patience. Focus on making fewer, high-quality trades instead of multiple day trades throughout the week. This not only helps you avoid the PDT rule, but also reduces the chances of overtrading and making emotional decisions. By staying aware of your activity, tracking your trades, and using the right tools, you can easily stay compliant with the PDT rule and avoid unnecessary restrictions. Thanks for watching. We hope this video helped clear up the truth behind making money from day trading. If you tried day trading or have questions about it, leave a comment below and we'll be happy to answer. If you enjoyed the video, give it a thumbs up and make sure you hit that subscribe button to stay updated with all our trading tips. Also, check out the links in the description for resources that can help you on your trading journey. Don't wait, click those links now and take the first step towards smarter trading. See you in the next video.